Obamacare is in the news again, and there's shifting healthcare coverage with some employers. This is your Market Checkup. So David, today there was a bill defunding Obamacare that was passed through the House. What does this mean?
Well, right now it doesn't mean a whole lot, Max. The bill still has to go to the Senate, where it will likely, the part that defunds Obamacare will likely be stripped out. It's a continuing resolution. This is actually the 14th continuing resolution, I believe, since the Republicans took over the House in 2011. It keeps the government funded. So if it is not passed, we could potentially see a government shutdown. What's going to be really interesting, and where the real showdown will be, is after the Senate strips out the part defunding the Affordable Care Act, whether the House then passes just a continuing resolution without that to keep the government funded, or if we will see a government shutdown.
Okay, so you don't think that Obamacare will actually be defunded?
No, I think there's a very, very small chance, near infinitesimal, that it will be defunded. I just don't see the president agreeing to gut his signature law that essentially bears his name colloquially. But there could be implications if it were, and I think it's important for investors to take a look at that, because at the end of the day, it will still be a law, even if it's not funded. It just will take a law that's going to be difficult to implement and make it near unworkable. The thing is, there will not be any money for the Medicaid expansion, so states will be less likely to expand and cover the lower income people in their states. There'll be no money for subsidies on the insurance exchanges, which means it'll be less affordable for lower income people to purchase insurance. There may not even be money to get the exchanges up and running and functioning correctly, so that could be another issue as well. And the other real important thing is that it's still a law, and so the tax picture of it won't change. So that ornery 2.3% excise tax on medical device stocks, that'll still be there. The penalties for not providing insurance for full-time employees on employers, that will also still be there. So it really doesn't improve the law in any way. It just actually makes it less workable. Okay, so I'm guessing there aren't any concrete winners and losers, because just before coming into the studio, I checked some of the big insurers, and United Health, Aetna, they're not really moving today. Well, I think that's because people agree with my position that there's a near infinitesimal chance of anything actually happening here that would impact the law. But there really aren't winners, because, like I said, the companies that are slapped with these taxes, like medical device stocks, which if the whole law were repealed would get a lift, they're not going to see that. So it's almost all downside. The companies that would be the worst impacted are those that are most tied to the functioning of the law, which would be the managed care companies, the insurers, and also companies that have received huge headwinds like hospital stocks. You take a look at the insurers, and they get hit twofold. One, we've seen a lot of acquisitions in the Medicaid space. WellPoint bought AmeriGroup, Aetna bought Coventry, and so if that expansion doesn't happen, the value proposition of those deals goes down fairly dramatically, and plus, they would still, because the laws don't go away, they would still be obligated not to discriminate for pre-existing conditions. So now all of a sudden, if there aren't subsidies, you might have less healthy patient pools in these exchanges if they're functioning at all. And all of a sudden, the insurers are now stuck with some of the least healthy people. That really messes up their dynamic. So, I'd be concerned about their business models if something like this were to happen. We've already seen Aetna pull out of 5 exchanges. If the patient pools don't look well, that could happen. That could happen more frequently. And hospital stocks have gotten a huge headwind. We've seen a bunch of mergers. Tenant purchased a company, and so there's been a number of mergers. And part of this is because of the belief in the decrease of bad debt expense if people are insured, if they're covered by Medicaid, that these insurers won't be treating people, or the hospitals won't be treating people for no money. If that reverses against them, then yeah, a lot of the gains that these stocks have made might be put under pressure going forward. Right, so definitely a lot of uncertainties in a lot of the sectors that we cover. But David, let's shift the discussion to kind of an emerging trend that's happening in healthcare, and that's changes that employers are making to the health benefits of their retirees
and part-time workers.
Yeah, we've seen a lot of changes there, Max. I mean, this has been an ongoing story. Trader Joe's was in the news just the other week for how they were changing coverage to their part-time employees. They were actually a company that had previously been applauded for covering part-time employees, and now it looks like they're sending them to the state-based insurance exchanges with a $500 check in hand. Recently, this week, it looks like Home Depot will be following Trader Joe's lead, although probably not with a check in hand. I didn't see anything about that, but they'll be cutting coverage for 20,000 part-time workers as well. What's actually a little more interesting to me is the Walgreens story, because they will be shifting all of their employees to a private exchange, one run by Aon Hewitt. So it's not going to be one of these public state-based exchanges. They're going to be giving their employees a check based on what they, on average spend for healthcare. So in theory, people are getting the same coverage, but it's an interesting shift from a defined benefit, which is everyone's covered, to a defined contribution, which would be, all right, Max, here's $2,000, go on this exchange, and good luck with it. Walgreens is pitching this as a benefit. We only offer 2 plans. This exchange will offer 25. People can find something more, but I see it as more of maybe an emerging trend of offloading costs or limiting the amount of costs healthcare causes to each company.
And again, this is very early in this new trend, so we have to see how it plays out. But will this really contribute to the bottom line of the companies that's doing this? Is this something that, as investors, we might be interested in?
I think it's hugely important, Max. I mean, you take a look at some of the increasing costs. It's not just a burden for the U.S. government. These companies offer. A lot of companies offer health insurance, essentially full health coverage to their full-time employees, and that is actually a big drain on the bottom line, especially as healthcare cost inflation tends to be an issue. Now, we've seen reports that healthcare cost inflation is down to 1%. There's a debate whether that's the recession or whether that's the Affordable Care Act making that down, or if it's a combination of the two. But for the most part, healthcare inflation has outpaced real inflation, and it is a drag on earnings. And it's going to be interesting to me if we see this, and I think investors, especially in companies with a lot of part-time employees, retail stocks, consumer goods, stuff like that, what they do, because it's an easy way to reduce costs going forward. If you can say, okay, we're going to spend X amount on our employees instead of we're going to spend some sort of nebulous number. And we've seen this change with retiree benefits. It used to be a pension model, and people would argue that's what helped kill the Detroit automakers. And now we have more of a defined contribution model where a company will say, okay, we'll give you, X amount to your retirement plan. And so they don't get drowned by these retirement costs, these defined benefits. So I think it'll be interesting to see. Now, in terms of the Affordable Care Act, Walgreens is going to a private exchange, but these state-based exchanges, should, in theory, be up and running in October. We've seen some reports already that they will, be at least a little buggy come October 1, but we're less than 2 weeks away. I think companies will wait and see how this runs for a little bit, but I think the Affordable Care Act gives them cover. They can say, listen, we're changing our healthcare policies because of Obamacare, and you can get subsidies and look at all these options out here. But really what they're doing is managing to maybe not dramatically impact their costs in the near term, but limiting the damage those expenses can cause in the companies in the long term.
Okay, well, definitely a lot of uncertainty, like I said before, and as the exchanges kick off in October, we'll see how everything plays out. In the meantime, if you're looking for more information on the ACA or healthcare stocks, be sure to check back to Fool.com.